So hello guys, welcome to this video. This is Pranav from Airlines University. Currently I'm pursuing MBA in finance. Today, let's quickly understand how the understand about the company we are analyzing, which is the Indigo Airlines. So, before we dive into this financial model, I will talk about this the company Indigo Airlines. So the Indigo is operated by the Interglobe Aviation, which is India's largest airline by market share, passengers carried, and the fleet size. So it started operations in 2006 with a simple strategy like low fares, on time, performance, and a clean, hassle-free services. Over the year, the focus on efficiency has helped Indigo build one of the most cost-effective operations in the global aviation industry. So today it controls more than 55% of the India's domestic aviation market. The airline operates an all-air-based fleet, which keeps maintenance costs low and allow faster aircraft turnaround. So Indigo follows a classic low-cost carrier model, but it has scaled that model better than anyone else in the country through high aircraft utilization, strong ancillary revenue streams, and disciplined cost control. So on the financial side, Indigo is known for stable growth, strong cash flow in good years, and a very structured approach to cost management. So all these factors make it an excellent company to study from a financial modeling and valuation perspective. So in this session, we will break down exactly how Indigo earns revenue, how it controls cost, and how the financial come together in a full integrated model. So have you ever looked at an airline and wondered how do they actually make money? Like it seems so complex with fuel prices, plane leases, and ticket sales, right? Well, today we are going to answer that question in incredible detail. We are going to spend next 20-30 minutes walking through a complete financial model for India's largest airline, Indigo. So we'll open this massive Excel sheet like you can see here right now. And I will explain not just what each numbers means, like how they all connected through it. So, whether you are a finance student, an aspiring analyst, or just curious about business, by the end of this video, we will understand how uh, the about the airline's profitability and all. So let's dive in. So first, let's look at the engine room of any good financial model, which is this assumption sheet. Here you can see. So this is where the entire forecast is built. Instead of hard coding number everywhere, like the smaller puts all the key predictions here. The rest of the model simply pulls from this sheet. Like this is a best practice because if you need to change a forecast, you only change it in one place. So let's look at the key drivers. The first one is ASK, which is the available seat kilometers. This is our capacity, how many seats multiplied by how many kilometers we fly. And you can also see the historical growth here, which is the 20%. It's from year 2010 to 2070. The data is here. This is the growth rate. And So next one is this one, RPK, which is the revenue passenger kilometers. These are the actual sales, like how many paid seats, how many multiplied by kilometers. So it's driven by the passenger load factor. This is the PLF. Uh, okay, next we can look at the yield. Like this is the average fare per kilometer per passenger. It is a critical driver of revenue. It is forecasted to grow steadily. So the number of planes and the ASK plane. This is a fleet plane. The model calculates the number of planes needed by dividing the total ASK by the assumed ASK per plane, which is 460 million. Okay. So the revenue streams, like we see the breakdown into passenger ticket, ancillary, which includes baggage, food, etc., and other revenue. Like their formula often link them as a percentage of total revenue. The magic of the sheet is the RSK, that is the revenue per ask, as I told earlier, and the CSK, that is the cost per ask. So RSK is equal to, like, it is the total revenue divided by the ASK, and CSK is the total cost divided by the ASK. So the spread between them, that is RSK minus CSK, like this is a fundamental measure of operational efficiency. If it's positive, you are making money on each unit of capacity you offer. You can see the RSK and CSK here, the values of each year from each year. Next, we can move to the income statement. Here you can see the, like as I told, the ancillary revenue, the other operating revenue, other income, etc. And also the tools and package cargo services is here. So let's move into the income statement. So this is a big picture, yeah, let's see how these assumptions flow into the income statement. This tells us the company's profitability over a period. You can see the revenue from operations here, the cost cascade, etc. The revenue from operations, like this comes directly from the sum of the revenues we saw in the assumptions sheet, which was the previous sheet. And the cost cascade, this is where it gets interesting. We start with the uh, earnings before interest, tax, depreciation, amortization, and rent. Why? Like, because aircraft rentals are a massive unique cost for airlines, and this allows for better comparison. The formula is total revenue minus operating fuel. We then subtract the biggest cost, which is the aircraft fuel. This gives us the earnings before interest, tax, depreciation, etc. So next we can subtract the actual aircraft rentals net of like incentives to get a more standard EBITDA. Then comes depreciation and the amortization. Like this gives us the earnings before interest and tax. So finally, after finance costs like the interest on debt and taxes, we arrive at the bottom line, which is earnings after tax or the net profit. So notice like how many of this costs like fuel and depreciation are pulled from other more detailed sheet. This is the models model are seen at work. So here you can see the asset schedule, cost metric, etc. So on the asset schedule, like this tracks what the company owns. Like it calculates the depreciation for our tangible assets like planes and intangible assets. The closing balance formula is a classic, like this opening balance plus additions minus depreciation plus or minus adjustments. The depreciation itself uses a cost and a rate. Uh, Here you can see the opening balance, adjustments, closing balance, depreciation, addition, etc. And the addition to the aircraft, gross amount of addition, cost per traffic, depreciation rate, etc. The intangible assets, opening balance, etc. You can see the amortization also, if you can see. So we can next move to the cost metrics. Like this is a deep dive into every single cost. Like it calculates aircraft fuel by forecasting fuel price and consumption. Like look at this, it links like you can see here, it links to an external ATF fuel forecast sheet. It also details employee cost, aircraft rentals, and more, and often expressing them as a percentage of total revenue for forecasting. Here you can see the details of the each year from March 11 to 2011 to March 2022. Here you can see the fuel consumptions in millions, average fuel price, fuel consumptions per block hour growth, passenger ticket revenue, ancillary revenue, other operating revenue, etc. And then here you can see the total revenue. Also, the aircraft fuel expenses are mentioned here, and the incentives, aircraft and engine rentals all are here. This is the percentage in percentage. You can see the depreciation and amortization and their values. Total expenses extra is here. Next, let's move into the balance sheet. Before that, there is this ATF fuel. Here, you can see the each year from April 1, 2010, which is the starting of the financial year, 2010 to the 2017 December. Each month it's recorded here. So you can see the HF price in also you can see it in the USD, Indian INR rates, and like the percentage changes in Brent dollars. You can see the US oil prices and also the date and the ETF prices of the next from 2000. I mean the continuation also here. There's a graph where you can see the from 2010 to 7. Here you can see the how the ATF fuel price like fluctuates throughout these years. See, like it's greater than MCX or Brent dollars the price. Next, we can move to the next sheet, which is our the main key area balance sheet. So here, while the income statement shows a video of a year's performance, the balance sheet is a photo at a point in time. Like it must always balance, like assets equal to liabilities plus equity. So assets is what the company owns, like the current assets, which is the cash and inventory, and the non-current assets, which is plain property, etc. So notice like cash and bank balance links directly to the cash flow statement. Liabilities, what the company owns, list includes debt from the debt schedule and various payables. Equity, the owner's stake. This is the plug that makes everything balanced. The formula for reserves. This is crucial. It takes last year's reserves, add this year's net profit, and subtracts dividends paid out. This is how the profit from the income statement flows into balance sheet. The checksum at the bottom ensures our model is mathematically sound and balances perfectly. Here you can see the checksum. This shows ensures, like as I told, this our model is mathematically sound and balanced perfectly. You can see it clearly here. So this one is the revenue matrix. Here you can see the each year's passengers ticket revenue, the ancillary revenue, other and operating revenue, etc. And other income and income from revenue from the operations are not down here, mentioned here. And the ASK is million in millions is not is mentioned here. And the number of aircrafts throughout the year, you can see it's increasing year by year because it shows that the like the demand and the number of passengers using Indigo Airlines is increasing each year by year. As I said in the during the inception of this video, like the people are more like to travel on flight, especially Indigo. As the fare price is less. It's like it's an affordable for a middle class people, and also the timings, the service, and also are, I mean, it's a value for price. So you can see the how their growth is here from this. You can see that, and like escaper aircraft yields. You can see the yields, the RPK in millions, etc. Here. Here you can see the debt schedule. This sheet is that. Here this tracks what the company was like. It follows a similar logic like opening debt plus new borrowing minus repayments equal to closing debit. The finance cost is then calculated on the average debt during this year. So this closing debt balance flows directly to the balance sheet. Okay, here you can see the closing balance. Next one is about the incentive part, like the additional aircraft, the additional incentives given, the incentive per aircraft, and the short term and long term, like that. Here you can see that. Next one is this cash flow statement. So, I can say that we can say that profit is an opinion, but cash is a fact. The cash flow statement reconciles them. Like we can the cash from we can say that cash from operating activities, like we start with the net profit and add back non-cash expenses like depreciation. Then we adjust for changes in working capital like receivables and payables. This tells us the cash generated from the core businesses. The formula for cash generated from operations is a long but logical sum of all these adjustments. So next one is the cash from investing activities. Like this is the cash used to buy new planes or receiving from like selling the old ones. Next one is cash from financing activities. This is cash from taking on new debt or paying it down, and from paying dividends. The bottom line is the net change in cash. This number gets added to the opening cash balance to arrive at the closing cash balance, which we saw on the balance sheet. This completes the loop. Here you can see the net cash generated or used in financing activities from March financial year 11 to 22, and also the net increase or decrease in cash and cash equivalent during the years, and effect of exchange rates different on cash and cash equivalents. Here you can see the opening balance and closing balance and clearly the deposits. Next one, this is the the each year from 2010 to the 2017, the ATF prices in different states and their averages. You can hear it's around the US dollars also, oil price. So this sheet is about the average of the ATF fuels and all. So this one, the last one is this is the valuation part. Actually, let's pause and appreciate this beauty of this integrated financial model, right? Like it's not a collection of separate sheets, or no, like not like that. It's a single sheet dynamic system. So this assumption sheet drives the income statement and revenue metrics. The income statement's net profit flows into balance sheet's equity. The asset and debt schedules detail the movements in fixed assets and loans. These movements, along with the net profit, feed into the cash flow statement. The cash flow statement's ending cash balances updates the balance sheet. Like if you change one assumption, like the growth rate in ASK or the price of fuel, it ripples through the entire model, updating the income statement, the amount of cash generated, the assets needed, and the final valuation. Like this is the power of the well-built model. If you try to change anything, it affects the whole sheets, whole part, etc. Now we'll talk about the like the from you can take the key takeaways from and business insights from the this sheets. Let's talk about what we learned about the this Indigo's business. Like it's a volume game actually. Like high growth in ASK, which is capacity and passengers, is crucial, and also it is also margin game. Like the tiny difference between RASK and CSK is everything. They must manage fuel costs, which are volatile and huge. It's a capital intensive. Like this model shows massive spending on new aircraft funded through a mix of debt and leases, and the ancillary revenues are growing and high margin lifeline. Ultimately, the business is a complex interconnected system. You can't look at ticket prices in isolation. You have to consider fuel, fleet planning, and financing all at once. So these are some of the the final valuation you can see has the, as I mentioned in the videos, EBITDAR, which is the earnings before interest, tax, amortization for that, and this is the earnings before interest and tax, etc. This is here, as you can see the depreciation, amortization, and the terminal values are listed here. Okay, here you can see the long time financing, loans, interest, the maturity weights, etc. here. So from this, I think, I hope you guys I hope you guys like this video, and we deconstructed this actual Indigo's financial model. Like we have covered from the income statements down to the levels of fuel consumption, depreciation schedules. I think you can use it for you can use this for analyzing any company's data. Like you will get a clear idea of how this companies work, whether this company will grow in the future, how this company is going the right way, how they are profitable or not. their future growth, their expectations, like is it a good company to invest, etc. You can analyze, and you will get that kind of ideas from analyzing this kind of Excel sheets. And also, like, actually you will get a idea about the company actually. So thank you for watching this video, everyone. Thank you so much.